Hello, today I'm going to talk about directors' loan accounts, what they are, how they happen, and what you can do about them. So first of all, what are they? Well, it's when either the company owes you money or you owe the company money. And so then how do they occur? Well, if the company owes you money, it's either because you've put money in, maybe at the start of the business, or because there was some cash flow difficulties, or alternatively, you haven't drawn out all the money you've been entitled to. So maybe you haven't taken all of your salary, or maybe there's been dividends declared by the company and you haven't drawn them, you've just left them in the company, wait until the appropriate time when the company can afford to pay you the money back. So if the company owes you money, your director's loan account is in credit. We say it's in credit because it's shown in creditors. Now, one thing to remember is that you stand in line with all the other creditors. So if the company does fail, then the chances are you're probably not going to get your money back. So it is important that you probably make sure that you take out as much money as the company can afford and you don't leave a huge balance in your director's loan account. Now, if it's in credit, there's a few things you can do. Bear in mind that this is money you can draw from a company tax-free because it's already had tax paid on it. So at the moment, you're allowed £1,000 a year of interest before you pay tax. And also bear in mind that corporation tax is rising to 25%. So if you're a 20% taxpayer, if you charge interest on your director's loan account, the company gets tax relief at 25%, and you can be paying income tax at 20% if you're at basic rate. You can't just pay the interest to yourself. You do actually have to deduct tax on it, and the company gives you a tax certificate. So you need to make sure that you complete the correct paperwork if you're going to do this. But it's a good tax saving opportunity. The alternative to being in credit is if you actually owe the company money and you have an overdrawn director's loan account balance. So it's a debit balance and it sits in debtors. Again, you've got to be careful with this because if the company was to fail, then the liquidator would come along and actually ask for that money back from you. So just be wary if your director's loan account does go into a debit balance. Now, it could be a debit balance because you've just paid personal expenditure out of the company, or you're just taking round some amounts over and above your salary, which happens quite often with directors. Now, it's okay to have an overdrawn director's loan account balance as long as it's cleared within 9 months of the company's year end. If it's not cleared by that time, the Inland Revenue come along and they want a tax on account. It's called Section 455. What they do, they look at the balance that's outstanding after 9 months and they take 32.5%. And that is deposited with the Inland Revenue. And they'll give it to you back, but you have to have cleared your director's loan account at some point. And so they're sitting on your money. So it's the incentive to make you clear your director's loan account. So how do you clear an overdrawn director's loan account? There's three main ways, really. Firstly, you can put the money back. So if you've had it and you weren't entitled to it, if you've got it personally, put the money back into the company. I have to say that most people don't have money sitting around and are able to do that. Secondly, the company can declare dividends. So a dividend is just the company saying, well, we've made profits and we're going to give it to the shareholders. The difference is this time the dividend is credited to your director's loan account and you don't actually take the money out of the company. Obviously, the company's got to be making profits to be able to declare dividends. That's pretty important. But also bear in mind, you're still going to pay tax on that. Now, at the moment, it depends on your personal tax rate. If you're a basic rate taxpayer, it could be 7.5%. That's also coming up with a recent announcement, the change to dividend tax. Bear that in mind as well. So think about the timing of your dividends. If you're a 40% taxpayer, the tax on dividends go up to 32.5%. again, plus that extra supplementary tax that's just been announced. Alternatively, you could say that you're going to declare a bonus through the payroll. You have to pay the tax and national insurance, and it's the net pay that goes to your director's loan account. Now, the company gets tax relief on the bonuses paid to you, so that's the advantage of bonus, that at least the company is getting some relief as well. But it's dividends and bonus. There's not a huge difference between the tax rates overall if you look at the company and yourself as an individual personally, but it's about timing of the tax payments more than anything else. Alternatively, sometimes people have expenses with the company and they submit the expense claim, but they just don't draw the money out to cover the overdrawn director's loan account balance. Well, I'd say whether it's in debit or credit, with both ways, there's lots of planning opportunities, and it is well worth speaking to your accountant about them, because there's plenty of things that we can do to help in terms of advising on the tax liabilities and the timing of withdrawing money or paying money back in, and how to account for it in the best way that suits your circumstances. That's a quick summary of directors' loan accounts, and I hope it's been helpful for you. Thank you.